Nvidia's stock has been on an incredible run, but did you know that passive investors might be missing out on these massive gains? Today, we're revealing the hidden pitfalls of passive investing exposed by Nvidia's surge. Stay tuned to understand how this impacts your portfolio. Hey everyone, welcome back to our channel. If you're into investing or curious about the stock market, you won't want to miss this. We're diving deep into how Nvidia's impressive performance reveals a significant drawback in passive investing strategies. Before we start, make sure to hit that like button, subscribe and ring the bell for notifications on our latest videos. Nvidia, Nvda, has notched its 43rd record closing high, bringing its 2024 return close to an astonishing 175%. However, if you're a passive investor relying on mutual funds and ETFs, you might not be celebrating just yet.
Recognizing the potential risks of excessive concentration, regulators impose strict limits on the maximum weighting any single stock can have within a diversified index fund. This is to ensure that no single stock can dominate the portfolio. These regulations aim to prevent funds from becoming overly reliant on the performance of a single company, thereby preserving the fundamental principle of diversification and spreading risk. However, these regulatory limits often lag behind the fast-paced market realities, making it challenging to keep up. By the time regulators adjust these limits to account for the rapid growth of companies like Nvidia, the concentration risk may have already increased significantly, posing a threat to the stability of the fund. This lag creates a window of vulnerability for passive investors, where their portfolios might be more exposed to the fortunes of a few companies than intended, increasing their risk unexpectedly.
The extraordinary rise of Nvidia, driven by its impressive performance and market demand, coupled with regulatory constraints on stock concentration and market regulations, has set the stage for a significant event: the upcoming rebalance of XLK, a major technology ETF. This rebalance, a periodic adjustment to maintain diversification and compliance within the ETF, is expected to reduce Nvidia's weighting to bring it back in line with regulatory limits and guidelines. This rebalancing has significant implications for investors, affecting their portfolio strategies. As XLK sells off a portion of its Nvidia holdings to comply with these regulations, it could create downward pressure on the stock price, impacting short-term market dynamics. This is not necessarily a reflection of Nvidia's performance or future prospects, but rather a technical adjustment within the ETF to ensure compliance and balance.
The rebalancing of XLK is not just an isolated event. It has broader implications for tech giants like Apple and Nvidia. As these companies continue to grow and dominate their respective markets, their outsized weightings in index funds will face increased scrutiny from regulators. This regulatory pressure could lead to more frequent rebalancing events, introducing a new layer of volatility for investors in these tech behemoths. While their underlying businesses might remain strong, their stock prices could be susceptible to fluctuations driven by technical adjustments within index funds.
The Nvidia saga highlights a crucial lesson for investors in the age of passive investing. Awareness is key. It serves as a reminder that even in a seemingly straightforward strategy, vigilance is indispensable. Even if you choose a passive investment strategy, it's essential to understand the underlying holdings of your index funds and the factors that can influence their performance. This knowledge can help you make more informed decisions. Don't be lulled into a false sense of security by the simplicity of passive investing. The market is dynamic and ever-changing. Stay informed about market trends, regulatory changes, and the performance of individual companies that make up your portfolio. This proactive approach can safeguard your investments. Knowledge is power, and in the ever-evolving world of finance, staying informed is crucial for making sound investment decisions. Regularly updating your knowledge base is essential. Remember, while passive investing can be an effective strategy, it's not a set-and-forget approach. Continuous monitoring is necessary. Active awareness and understanding of the forces at play in the market are essential for navigating the complexities of today's investment landscape. Stay engaged and stay ahead.